Hello and welcome to our World Built Environment Forum webinar series. My name is Julian Josephs, president of Julian Josephs Company, an adjunct professor of global real estate at Georgetown University. I'm the moderator for today's webinar, where we will be discussing the effect of the COVID-19 on commercial real estate investment flows in America and elsewhere, and what the future holds. We have a leading panel of experts with us today, and I'm going to invite them to introduce themselves now. Martin.
Thank you, Julian, and hello, everybody around the world. Thanks for tuning in. My name is Martin Bruhl. I am working for Union Investment Real Estate based in Hamburg, a member of the board and chief investment officer overseeing all transactions worldwide, which in the last pandemic year, 2020, was actually 4.1 billion. So it's sizable, and I'll come to where we made these transactions in a minute. The company overall is part of Union Investment Group with 420 billion euros of assets under management, and our little real estate subsidiary that I work for has AUM of around 50 billion euros. So a diversified portfolio around the world, and obviously with winners and losers following the outbreak, something like 14 months ago. I can't believe we're doing this for 14 months now, Julian and colleagues, but here we go, virtual webinar. Thank you.
Silvia Gross, who is Managing Director and Head of Capital Markets and Investor Relations for HU Capital. Silvia, would you like to introduce yourself?
Sure, thanks, Julian. Yes, Silvia Gross, and HU Capital Real Estate is a real estate investment advisory firm. We've been around for over 30 years, have brought in, we focus on inbound capital into the US and from all over the globe, but with a very, very big focus on Europe. And we have invested over $15 billion in US real estate assets. I personally have been at the company for 18 years and part of the investment committee, and focus on capital markets, investor relations, as well as all of our financing for all of our underlying assets. And I'm very happy to be here and sharing whatever we know about the inbound capital world for real estate in the US.
Great. Silvia, thanks very much. And our third speaker is Will McIntosh, who's Global Head of Research at USAA Real Estate. Will, over to you to introduce yourself.
Thank you, Julian, and thank you everyone for joining us today. It's a great topic and one I'm looking forward to discussing. As Julian mentioned, I work for USAA Real Estate. We're roughly a $30 billion real estate investment manager with a focus in the US and Europe. Primarily on logistics, and housing, but we're also doing a number of different things with several different funds. We're focused in the debt and equity space. With teams that include our Square Mile team and our IDR, which is an index fund that we have that invests across the Odyssey. And my job is to provide support and guidance for strategy and investment process across all of our different businesses. So it's great to be here, and as I said, and I'm looking forward to discussing the interesting topics we're covering today.
Great. Well, thanks very much. We're thrilled to know that we have over 250 registrations from 45 countries, which shows the breadth of RICS. Before we start, we always welcome your active involvement. I'd like to tell you that you can submit questions via the question box. We will put those to the panel as we go along, and if there's not time, hopefully we'll try and get the questions answered, or a few of them, after the session. Anyway, let's move on to the first question. How are investors attuning to their asset holding strategies to cope with the COVID-19 fallout? I'd like to hand this to Martin Bruhl.
Thanks, Julian. That's an interesting one. First of all, and sorry if I sort of preach to the converted, there is no such thing as the investor. And obviously you'd appreciate that there are so many different strategies, investment styles, capital sources, risk return preferences, and degrees of diversification in existing funds, for example, that make it a case by case analysis, really. If I can speak from my point of view, speaking for a German institution, something like 60 years old, running 25 funds in total. Some of them are actually pretty vintage, 50, 60 years old, evergreen funds. They are highly diversified. They have very broad shoulders and can stomach risks because they are diversified, not just geographic, but also sectorally. And we've got new funds which have been recently launched and who have speciality focuses, such as just hospitality or just retail. And you can tell from that wide variety of just one operator of fund and asset management here in Germany that it's a difficult question to answer. But I mean, let me just try from my perspective. Obviously, people around the world and our peer group here in Europe are trying to rebalance their portfolios. Which is now 14 months into the pandemic, at least the pandemic as we have experienced it in the Western world. Obviously in Asia it started much earlier. We have certainly identified the winners and losers of this first experience of a global pandemic in our lifetimes. And the irony is that, as Julian, we're all kind of like lemming-like jumping to the same conclusions. People are skeptical about hospitality and discretionary, at least retail. Everybody seems to be buying beds and sheds now, which has seen an enormous oversubscription in deals and cap rate compression, to the point that one thinks whether there's now inherent risk in these sort of so-called resilient asset classes. So it's a worldwide rebalancing going on, but it doesn't happen overnight. As we all know, and again, this is like a textbook introductory chapter of real estate courses, and you're a professor at university, Julian. Real estate is a pretty illiquid asset class, and I can tell you it has not become much more liquid in a global pandemic with all the uncertainty, the lockdowns and the travel bans. So to rebalance and to attune holding strategies to cope with the COVID-19 fallout means that you have to gradually try and dispose of assets where you think you're overexposed. And can I just say, we have very robust funds. One of them is actually quite heavy, 14 billion euros of assets under management, but 50% of that is office. And the other 50% more or less is retail and hotels. Now, in order to move the needle, if you want to buy, for example, residential multifamily into that fund with 14 billion, in order to move the needle, if you want to increase the proportion of logistics, you got to really find the right deals. You got to find portfolios, especially because these things are pretty granular. You know, a shed is not kind of a CBD high-rise in Manhattan or in Tokyo. So you got to buy lots of these, and it's going to take some time. So there's some rebalancing going on. Beds and sheds is the flavor of the month. People are ever so skeptical about hospitality and offline retail, except for certain retail users, and I'll probably expand on that later. I don't want to sort of speak too long at this initial question, but a lot is going on, and it is a gradual rebalancing that is going to take place, and the end will take it'll take years for this to find a new equilibrium. In at least core investment strategies, and obviously we'll expand a bit later on that.
Great, Martin. Thanks very much. Silvia, Will, do you want to add anything to how Martin's response?
Yeah, this is Will. I would suggest that prior to the pandemic, I think there were a number of investors, including ourselves, that were of the mind that there was a high probability that we were probably going to be heading into a recession anyway. And I think many investors had started sort of tuning their portfolio, if you will, to be in a position to where they could weather a recession, doing things like focusing on really focusing on asset management and positioning your assets such that you've got your income streams in place and you could work through a recession. Now, little did we know that when it came that it would be caused by COVID-19. I mean, we were thinking it was going to be caused by other things, more traditional causes for a recession. But I think many investors were already positioning their portfolios by getting their leasing done and focusing on asset management in preparation for a possible recession.
Great.
Yeah,
Thanks
I
very
think
much. Yeah,
I
Silvia.
also want to add that I think it also depends, and I think Martin alluded to the different kinds of investors, and I think it also means the different kinds of assets and asset strategy. And I think, as we know, the pandemic hit different asset classes differently. And so there is not one recipe for all. I think some groups really were very temporarily affected by the pandemic, while other asset classes were changed forever, potentially, or for when we say forever, nothing is forever, and definitely not in real estate. But for several years, it will probably be affected, while other asset classes have not. And so I think depending on what your focus was, uh, where you were coming from, what type of assets you were investing in, with what investment horizon, right? Because somebody who is in an evergreen fund, as Martin mentioned, has a different stability that somebody who is in an opportunistic, redevelopment of hotels type of funds. So there isn't one, like in most real estate, not one solution or one answer to this question. I think that different asset classes were affected differently, and so the investors on those had to cope differently.
Can I just add one more thing? Thanks, Will and Silvia, for adding this. But it's so difficult, given the current restrictions, to really change your holding strategy to do something. I mean, in markets which are not as huge as the US, for example, traveling within Europe is a real problem. If you stay in France, for example, a neighboring country to Germany, if you stay for longer than 24 years, you've got to be in quarantine coming back after a negative PCR test for 10
Sorry,
days.
Martin, not 24 years, 24 days.
Did I say 24 years? Yeah.
Yes.
Did I? No, 24 hours. Sorry, this was.
Right.
If you stay in one country to do an inspection, and the thing is, I mean, you gotta be doing property inspections like a hit and run thing. You can't stay overnight, because if you stay longer, you gotta be subject to these COVID-19 restrictions and the testing and the quarantine rules and stuff like this. So the whole thing has become a much more deglobalized real estate market. It's a more domestic market. People have rediscovered their home bias. I mean, we did 4.1 billion of acquisitions last year, 0 disposals, interestingly enough, because nobody wanted to buy our stuff or could come into the country during the lockdowns and travel bans. So we bought virtually the stuff around where you could walk to in Hamburg, where we could cycle to, if you like, or cross the border by car, because there was very much restriction on air travel as well. So in order to rebalance a portfolio, if you have a relatively small constrained market, it's going to be really difficult. The US, hugest real estate market in the world and what have you, most liquid and so on, offers far more opportunities for investors to rebalance, which comes to my point of initially saying there's no such thing as the one investor. They all have different kind of starting points and frameworks within they can work, or constraints within they have to work.
Great. Good. Well, Martin, thanks for clarifying that. Let's go on to question number 2. This to Silvia. How have cross-border investment flows held up during the pandemic?
Yeah, well, I think that Martin started alluding a little bit to that in the last part of his statement here. It definitely has been difficult for foreigners to make investments, and I think in the U.S. or from the U.S. going into Europe, but focusing on inbound capital into the U.S., the first quarter had gone off to a great start, right? And then there was an absolute standstill. I mean, I don't think that anything happened in the second quarter. There were no transactions. So that wasn't even just cross-border. That was everything was frozen. And then in the third quarter, you saw things starting to reopen slowly. But again, it was also by asset type. You know, obviously hotels, retail were completely frozen, and frozen because there was no trade. There was a complete disconnect between, and that lasted, and it's still pretty much going on, between buyers and sellers' expectations on the most affected asset classes. Personally, our company focuses exclusively for the last 10 years. Initially, we did commercial and residential, but for the last 10 years, we've been exclusively focused on multifamily. And I have to say that similar to industrial, it's an asset class that was much less affected, and it opened up. Transaction liquidity in that market opened up by the end of the third quarter. We, different than Martin, were selling. There was an incredible demand for it. Again, there was not the same volume of transaction flow, and so what did come on the market got great prices. But we saw that there was much more of a domestic buyer. I mean, residential in general historically had been more of a domestic buyer, and in the last years it had grown to also attract a lot of international, but it was definitely much more on the domestic front. A lot of everybody on a global basis was unable to deploy the capital that they had targeted for 2020, but in particular across border, we saw a great decline. We did see incredible activity in multifamily in the fourth quarter. It was actually just as high as the activity in the US as the fourth quarter of 2019. So multifamily, and again industrial also, but multifamily in particular was had a very, very strong end to the year in the fourth quarter that really was a surprise to all, but much more concentrated on domestic. It's the direct acquisitions has been mostly domestic. What the foreign capital has done is they have gone more into indirect acquisitions, where they might not be as important to travel. So indirect acquisitions, I think, picked up as well from a cross-border basis in the third and primarily in the fourth quarter. But direct definitely did suffer because of the travel ban, the inability. I mean, you saw it even in the US. People didn't travel as freely even within the US. So I don't know of many companies that even allowed travel. Forget the restrictions. Companies were not allowing the travel, which made it very difficult. So you were relying on prior partners, and you were relying on other cooperations or existing relationships that you had in the past to help you out with inspections. And that obviously is easier if you're within the US than if you're coming cross-border. So we raise capital from family offices, and it is indirect acquisitions. We raise funds, and then those funds invest in real estate. And we had actually finished fundraising on April 1st. Was the close of our fund, had already been intended to be so. So we were not in the fundraising mode, but we were expecting to start in the fourth quarter, and we did delay it because, again, not being able to, in our case, meet with investors made it a little bit more difficult. But we've seen a great reopening in terms of cross-border investment, even though there's still travel restrictions. But I think people are getting more comfortable and finding more ways to do more indirect and to rely on other groups, hire local representatives or corporations for people. But we definitely saw a decrease in cross-border flows all over.
Great, thank you. Will, do you want to add anything?
Yeah, I first of all, I want to give a plug to the AFIRE organization, and the fact that they just completed a survey looking at capital flows around the world, and I wanted to make sure I mentioned that today because they're showing that we are seeing extensive, and there are plans for extensive investment in the U.S. going forward. Significant amount of capital flows. Over 75% of the respondents are expecting their volume for U.S. real estate investment activity to continue to increase here in 2021. And a third of them are talking about very significant increases. So the capital flows are certainly flowing to the U.S. and are expected to do so. With still a fair amount, 25% going into Europe and maybe 4% into the UK. So there's capital flows are certainly moving again, and a lot of it is looking at the U.S. We could speculate why, but I think everyone has an opinion about that, and we can talk about that if you like.
But Will, how much of that, because I know that is the intention, for various reasons like diversification or the quality of the assets, the return and the liquidity in the US, but how successful is the issue, will it be? Because we're now already into practically May and the borders are still closed, not closed in the true sense, but you're not seeing Europeans coming, you don't see Asians coming into the US. The capital is coming, in greater numbers definitely than it was last year, but I think everybody has that intention also because they have so much dry capital that they need to deploy, and they can't do it just in their domestic markets. And as much as Martin likes to buy all of Hamburg, between Union and all the other Germans, they have more money than Hamburg can supply, So there's more capital than they can deploy domestically. So definitely people want to come. But I guess the question is, how successful will we be all in doing these cross-border investments?
And yeah, that's a fair question, Sylvia. And I think that what it means, at least for now, we'll see investors using their existing managers to deploy that capital. Probably won't be adding a lot of new managers until we can travel more and do our due diligence and things like that. So I think in order for this capital to get deployed, investors are going to be relying heavily on existing managers to help them do that.
Okay, thanks.
Yeah, that's
Martin,
why I keep saying the indirect is so important.
Yeah. Martin, do you want to add anything?
Yeah, I just wanted to stress that I think we have to various degrees been struck by the COVID-19 fallout in our real estate portfolios. And I think the real solution out of this is growth and diversification. Really to create that balanced portfolio from resilient asset classes being brought into portfolios which have traditionally used the classic food groups, the office, the hospitality, the classic retail, the shopping mall and stuff. I think it's only growing out of that exposure, and you can't just sell because there's capital lined up, on the sidelines, as in every crisis, the vultures who want to have cheap deals and look for distress, but there isn't enough distress as yet. People are holding on to their portfolios. There's a less liquidity in the markets because of that. So in order to not be able or willing to sell at any price, you can only diversify out of the current structural issues in your portfolios by growing and diversifying, and that you can't do in your home markets. You're absolutely right, Sylvia. You can't do this in one major German market, but you can't do this even in Europe. You've got to go to the United States, which is the most liquid, the deepest, the most transparent and efficient real estate market in the world, and that is something which we're really waiting for. When do the borders open again? There is ongoing restrictions and concern about business travel in the future. So the jury is still out as to when this is going to come up again. But the interest certainly is there for cross-border investment and for diversification through growth.
Great. Well, let's move on to the third question. This is for Will. as economies reboot following the pandemic, what economic, financial, and policy headwinds and tailwinds could affect commercial real estate investment, either directly or indirectly?
Yeah, great question, Julian. And I think if we focus on the tailwinds first, I think there's a lot of interesting things happening that are providing tailwinds, certainly with the global and economy in the U.S. We're seeing now, fortunately, a broader distribution of the vaccines, which should help open things up. We're seeing a lot in the U.S. In particular, a lot of economic stimulus being added to the economy. We've had over $3 trillion now, and there's talk even today about adding several trillion more for various projects and things. I think this is going to have a huge impact on GDP growth. I know in the U.S. we're talking about maybe a 6.5% GDP growth this year, trailing off a little bit to 4% next year, but certainly still a fairly strong growth. We're operating in a low interest rate environment, which is there for a reason, and that's in part to help stimulate the economy. We've got in the U.S. we're seeing declining unemployment rates, currently at around 6%, likely to go to around 4% by the end of the year. And as we've been talking about, we're seeing improving demand for commercial real estate and strong investor interest in commercial real estate. So there's a lot of tailwinds that are pushing the economy and the commercial real estate market that could bode well for investing in real estate. But let's be clear. There are headwinds that we need to be concerned about. There are supply chain issues that are and there are labor pool issues. Even though the unemployment rate's been coming down, there's still issues with. There's a whole lot of people that are drawing paychecks and unemployment and that are being paid basically are not working and aren't coming back to work, at least for a while. These are supply chain issues are causing, at least in part of the inflation that people are worried about. We're seeing prices jump significantly across a lot of different items. And fortunately, I personally think this inflation increase is going to be short term. It's going to be transitory, but it's still going to be a factor. And now, even as recently as this morning, there was significant talk about major tax increases that are coming. So that certainly could have a huge impact on the demand for real estate in the U.S. And I always, one of the things that keeps me up at night is regulatory action and worrying about the politics and what government's going to do that might impact the regulation of our industry. And certainly there's things that have been happening there over the past year. And then finally, I think the big overlying headwind that we need to be consciously or constantly aware of are the demographic trends and the fact that our population is aging here in the U.S. And we're probably looking at a slow growth, low yield environment. The current age cohort that's driving our economy right now are the echo boomers, which is a very small group behind the baby boomers, and they're going to be driving our economy for the next probably 8 to 10 years until the millennials and Generation Z start to have more of a major influence. And so we're probably going to circle back to a more slow growth environment, say by 2023 and beyond for a while. So these are headwinds that we need to constantly, I think, be mindful of.
Okay, great. Martin, you have something to add?
I couldn't agree more with what Will has just pointed out. I think we're not quite through yet. I mean, in terms of headwinds, I can see Europe struggling much longer than the other world regions, and therefore, I mean, we're all in a bit of a hype at the moment. I mean, it's amazing what you can do with a new face in the White House and 1.9 trillion dollars of stimulus package, but it's actually also potentially fueling what we'll refer to as inflation. It's potentially fueling asset price bubbles, and it's something which I think we need to watch very carefully. And Europe is in a way benefiting from the hype, and this series, of course, is also entitled the first 100 days in Joe Biden's America, but the jury is still out as to when Europe will be able to catch up, and it's a global economy that we need to stimulate here, and the US are doing pretty good, but asset price bubbles is something we're concerned about here in Europe.
Thank you. Silvia, what effects will the pandemic have on investor risk appetites?
Well, I think it's very whether you're in core, whether you're historically have been in core, whether you've been in value add, whether you've been on the opportunistic side. In general, I think it's switched and made certain asset classes that were not core in the past. It's made them core. I think industrial is certainly one of them. Logistics, it was not considered a core asset class in the way that it is now, and it's become a darling. Multifamily, I laugh because Union that had never even, in this time goes back to like 10 years ago discussing with Martin about, multifamily, and no, we're not doing that. We're not doing multifamily in the US. It's, not something we're going to do.
And now,
now,
Silvia, we have now seen the light.
exactly. And now all of a sudden Union is adding multifamily.
At the time, it was a pain to manage, all these individual tenants. And today we praise the granularity of the cash flow.
Exactly. And so it's made it much more core. I mean, if we're afraid of inflation, multifamily certainly is the best hedge against inflation because of its 1-year leases, and the diversity of the tenant base. But the 1-year leases made it a great hedge against inflation. So I think in general, the investors' risk appetite, I think, has been driven primarily by the fact that you have no yield in the bonds, and so, and this has been something was happening already before the pandemic, right? That people were stretching for yield and going farther and further out, and so I think the beauty of this is that in general, real estate has become in general much more core. People don't view it as risky or as illiquid. There's a great demand for it in the global markets. So in general, I think people are also looking for the distress, as Martin mentioned, but there is really not much distress except for in certain asset classes. And it sounds funny, but New York has some distress, and opportunistic buyers are going there. So it's shifted the definition of where the risks are. Before, it used to be that the risk was in tertiary markets and the risk was in asset classes that now have become core, and certain markets that were more risky or have become less risky. I like this thought that, the idea that buying multifamily in New York is an opportunistic buy, when it's been years to decades since we heard that. I mean, I think after 9/11, New York was seen as opportunistic. And even during the financial recession, New York wasn't even as opportunistic as it is now in some people's eyes. So there's been a lot of shifts. Again, it's not one investor, not at one asset class. I keep repeating that. And so the risk appetite has changed by what are you looking for? And I think that we're finding that people are going back to looking at the distress, and they're not finding it much except for hospitality and some retail. The rest, there isn't that much distress out there. So a lot of people are flocking into core. But that is not something different. That's been always the case. People, it's just what is core might be different than was before.
Okay, great. Thanks. Silvia, this leads more into your next question as well. First of all, Will or Martin, anything to add there, or should we just go into the next question?
Well,
we can
this
come
is
back on
Will.
that later.
This is Will. Let me just say that Silvia is absolutely right. I mean, one of the things we've been seeing, and we saw in the AFIRE International Investor Survey results, was that a lot of the capital, or majority of the capital, is still flowing into core. But it looks like it's actually starting to trend down, and that more people now coming out of COVID are planning to take on a little more risk and focus on value add. And one could make the argument that in a low interest rate environment like we're in now and likely to be in going forward, that now is the time to take on risk if you're going to take on risk with interest rates as low as they are. So it's going to be interesting to see how this capital continue to get deployed, but it's clear that more and more capital is wanting to take on a little more risk to, I'm sure, enhance the returns.
Great. Martin, how is investor view of office and retail sectors changing?
That's a lovely one. I mean, Silvia just alluded to this when she looked for some form of minor distress somewhere. Listen, investors are human beings. I think we all agree, and they may be particularly educated, sophisticated, experienced in their field, but they are human beings forced to make business or major investment decisions in times of heightened uncertainty at the moment. It's heightened uncertainty given all we've experienced for the last 14 months. And although I'm not a behavioral scientist, but there are a few mental stages that I have gone through, my peers go through, and I don't think anybody is really immune against, initial feeling in office, for example, of denial in Q2 2020, a year ago. There was some denial, oh, it's not going to affect the office, it's just temporary. And I think a few months later, there was some awareness of maybe the new modern working models that some big companies have proclaimed, very early on, more than a year ago. Siemens, major German firm, have announced that they're going to send their 140,000 employees in a new working model that involves 3 days mobile working, including home office. So there was some awareness coming up, and I think we're now in a stage of a bit of concern how future kind of patterns of office use will pan out. And we expect come next year that there's going to be some form of polarization, that companies will effectively maybe cut down on back office and want to have more representative core office space, if you know what I mean, core to represent the company, to bring their employees from their mobile working outposts or home offices back occasionally, to build teams, to create identity and so on. So from denial to awareness to concern, there may be some polarization, winners and losers at the end. In retail, you were asking, Julian. I mean, we had a year ago, we had clear anxiety. Yeah, we had I think a few months later desperation. Some have actually capitulated by now, and we'll see again that we're going to find some polarization going forward. Some courage also for resilient use classes. I mean, everybody is not only jumping into beds and sheds, i.e., multifamily and logistics, but they're also looking, of course, for grocery-anchored retail, non-discretionary spending. You have to buy that sort of that food basket, or you have to buy your toilet paper, that kind of stuff, non-discretionary spending. So we'll see that in other use classes. Look at logistics. I think both Silvia and Will have touched on that. I think a year ago there was excitement. Wow, I mean, we bought €1 billion of logistics last year. Some overflow from 2019, but we still, bought a couple of portfolios. Crazy. So we really doubled our exposure there within 12 months or so. But this excitement, I think, for some now, if you look at the logistics market, is transformed into euphoria. I mean, we have cap rate compression in the logistics fields. We have a discrepancy between the replacement cost and capital values, which are crazy. I think there's going to be some momentum still at the moment. It's going to continue, but guess what? I think next year people will start to feel a bit uneasy about the pricing. And in certain markets where there's less planning constraint, there may be unease because of the cheapness of replacing assets and building competing assets in certain markets, not in Germany, for example, but others. And this is kind of when you ask me how is investor view of office and retail changing, it's changing in all these fields. I mean, if I may, Julian, just 30 seconds, look at hotels. I mean, I think a year ago there was clear panic. I think now people are more, diverging in their opinions, and there may be more tourism as soon as people are vaccinated. Airlines are kind of putting a few more planes up in the air, but business travel, gosh, I mean, similar to the home office and mobile working use, companies will cut down on business travel, definitely, because we have had the biggest field study of mobile working and virtual conferences like ours here and so on. Why fly to another city for a business lunch? Forget it. It's going to be gone. So there's various stages, and I'm not, again, a behavioral scientist, but views are changing. There's a lemming attitude, run for beds and sheds and grocery anchored retail. And at that point, when everybody runs into this, you're going to see price explosion and bubbles being created. And those areas which are overlooked, may actually get more attractive. So maybe at some point we're going to be, very happily buying more office and so on. So it's a long answer, sorry about that, but I just wanted to expand a bit outside just office and retail, which are so obvious, but others have gone through excitement to potential unease in due course.
Great, thank you. You sort of practically answered the next one, is alignment investment portfolios away from more exposed commercial real estate sectors towards more resilient ones slightly, and you sort of answered that question.
I think, yeah.
With the answer. Silvia or Will, do you have anything to add there?
I think he covered it well, and I think it's going to be interesting to see how office in particular shakes out. There's obviously mixed viewpoints on whether or not people are going to be coming back and into the office completely and using the same amount of space, whether or not more people are going to be working from home. I would say that there's going to be tremendous opportunity in office, because the type of office space that tenants are going to want going forward is going to be changing, and a lot of the office space that we have out there now may require significant redevelopment, or may actually just become functionally obsolete, and we may have to figure out a reuse. I used to say the only thing that was wrong with retail in the US is it's not overbuilt, it's under demolished. And I'm a little bit worried that the office market is becoming somewhat the same way because of COVID. But I do think there's still going to be opportunity in the office area as people come back to work.
Okay, great. Thank you. Silvia, is the new focus on secondary cities here to stay, or will it be the primary cities that will again regain first place?
I love that topic, just because we have been in secondary cities for 30 years. We have always focused more in secondary cities, and for some years we used to call them growth cities instead of secondary cities, because secondaries had this negative connotation to it, right? If you weren't one of the gateway cities of 4, 5, or 6 top cities, there wasn't as much, especially from a global inbound capital point of view. You know, many people they didn't have them on their radar. They were not interested in them. And we always liked them, but we didn't want to call them secondary cities. Now people call them secondary cities and say they invest in secondary cities with pride, with, you know, it's a great place to go, these secondary cities, and even tertiary cities. So we strongly believe that this is a trend that's here to stay. That does not mean that the primary cities are dead. It means that we have expanded the number of cities that have become prime targets for investment domestically and from a global point of view. You know, again, cities like Atlanta, people knew it, but not everybody was ready to invest there. But cities that were less known, like a Charlotte, you know, I always say people invested where you had a direct flight from Europe or from Asia. Well, now people are investing in places where you might not have a direct flight and you have to have a stopover. And they have learned that you know, people live there, and there's tremendous growth. And I think the secondary cities that have a tech focus are going to thrive and are going to do extremely well. And that includes, you know, cities like Charlotte and Austin, and obviously Portland and Oregon. And there's a tremendous number. Phoenix, you know, Phoenix is a city that has attracted a lot of migration from California. So I don't want to say that primary cities are dead. Absolutely not. New York is going to continue to be New York, and San Francisco is going to continue to be San Francisco, and there's going to be investors who are going to continue to be very, very attracted for the right reasons to these cities. They might not be the in flavor today, but they're not dead. They don't vanish from the planet, and they don't vanish from the you know, target for investment purposes. I just think that the growth cities or the secondary cities are now the primary focus, while the primary cities are currently a secondary focus. That's how I would put them. That doesn't mean that, again, that they're done. So I think that the growth, it's the census, everything shows it, is going in that direction. I thought it was very interesting that the new census shows from where Congress delegates are coming, and we lost in New York some, and we lost in California, but we gained in Texas. That to me is a clear evidence. Where are people migrating? They're migrating to the Sun Belt. They're migrating to places that have better quality of life. And so the demographic shift is there, and the jobs are obviously there. And so I think we have expanded our palette in terms of the number of cities where global capital is looking to invest. So I'm very positive that they're here to stay.
Okay, fine, that's great. Will, do you want to add anything there, or Martin? Otherwise, we'll do the final questions.
I would just say that I agree with Silvia. The secondary markets and tertiary markets is becoming a lot more interesting in terms of offering, in terms of, first of all, in terms of growth, and then offering the ability to earn a higher return, and not having to compete with all the capital that has flown into, if you will, in some cases into the gateway and even the primary markets. But I would, you know, you do have to be careful. You need to focus for sure on the growth markets, and you need to be mindful of the fact that it could be a little more difficult to exit these markets as compared to the gateways, because there still tends to be somewhat fewer investors in these markets. So transaction activity, transaction volume may not be quite as high. Although, to Silvia's point, I think that's changing, and it may not be as they may not be as illiquid as they have been in the past. And I do agree that there's a lot of opportunity there. And I going back to the International Investor Survey that AFAR just did, it clearly indicated that there is increasing interest in secondary and tertiary markets.
I mean, from a European perspective, sorry, Julie, if I can just add that. I mean, the irony is that these so-called secondary or tertiary markets, I prefer the term growth indeed, Silvia. These markets have capitalizations and stock the size of Munich easily, or the size of Berlin, what have you. So, I mean, from a European perspective, the US offers a lot of diversification potential for sort of the second tier outside the peer group of 24-hour gateway cities. The only thing is, of course, if everybody rushes into these now, the cap rate compression there is going to eat up all the little premium you may still get in less liquid, as to your point, Will, markets. And again, you maybe have to sort of go the other way and be a bit counter-cyclical and look there where others are not looking. So, and one more final comment. Final comment. If everybody only invests from Europe in markets in the US, Silvia, where there's direct flight, it's going to be a very, very calm next few years, because the airlines have certainly slimmed down their itineraries. And oh my God, anyway, little comment.
I just
formerly frequent traveler.
No, Silvia.
Yeah, I just think that it's a little bit of a catch-22 or chicken and the egg, because there was a huge cap discrepancy between secondary and primary cities, and that definitely has compressed. But the question is, do they really warrant it? And again, as Martin said, Munich is a size smaller than Atlanta, and yet Munich has the lowest cap rates in all of Germany. So when you think about it, maybe there was no real justification for a much higher cap rate in Atlanta than in New York, because you have growth, you have employment growth, you have the things that should drive the cap rate and the liquidity is really the employment growth. And yes, there's 10 million people in New York versus 2 million in Atlanta, or 3 in the metropolitan area, whatever it is. But they're still sizable, huge cities, and the growth and the employment is going towards those areas, and in particular the tech cities. So maybe the fact that we were looking for a premium or a discount, whichever way you look at it, in these cities, a discount on the cap or a premium on the returns, maybe it's something that's not going to exist in the future, and we will just accept it as that is how it is. We no longer are a country of 5 cities; we're a country of 25 cities.
Great.
Good point.
So, Silvia, we've got panelists. We've got another 8 minutes left. We've got 2 questions to cover. I'm going to put them together. At what level do we expect cross-border investment flows to be, say, in 12 months' time? And how optimistic are you for the future, and for what reasons? Could you try and answer those together, each in turn? Martin, why don't you go first, then Silvia, then Will? About 2 minutes each, 3 minutes each. That'd be great.
I've said so much, I won't need 2 minutes, and it's again a tricky one. I mean, starting with the obvious one, I'm optimistic about the future, because if I weren't optimistic, I should change my job. If you don't price in growth, rental growth, if you price in a 10-year cash flow too much exit cap rate expansion because you're ever so pessimistic about functional obsolescence, you can be a very wise underwriter, but you're never going to make a deal. So I'm optimistic about the future, but of course, against the background of the things I've said today, with the various degrees of emotional stages you go through as a player in this various use classes. I am also optimistic about traveling easing up next year. I don't think that we're going to see much ease of doing business for Europeans coming into the United States. I mean, there is currently this, I think, early March rule which is called the national interest exemption. I said, oh, that's great, national interest, I've got a lot, but I was mistaken in the interpretation, because it's actually, if I come over as a German businessman wanting to deploy capital, it's going to be in the interest of the United States, not Germany. So we're actually going to be prohibited from coming over as business travelers in masses, as we've done before the pandemic, for quite a number of months to come, especially also given the backlog in vaccinations here in Europe and stuff. So it's going to come back next year. It's good for those guys like Union Investment, by the way, who've got people on the ground, feet on the ground, boots on the ground, and trusted advisors. So I think we will be able to do deals, but not in the volumes that we've been doing when we were traveling freely around the globe. And the same applies, of course, to other world regions, Asia Pacific. You don't ask me, hopefully, for a figure. Now, what inflows will be, they will certainly be less than 2019, I'd guess, simply because of that restriction also or that reduction in travel availability and business travel from a company point of view. So
Okay,
yes, optimistic, but it's going to take until next year. Sorry to say that.
Okay, fine. Silvia, do you agree?
I'm optimistic over the next 3 to 5 years. I think I'm less optimistic on the long term, but not for the real estate asset class itself, but for other headwinds, general global headwinds. And I also think that, you know, the stimulus has been great and it's creating, but the next year after the stimulus is absorbed, how we handle this debt and all that is going to be key. So real estate does not operate in a vacuum. I think real estate, I'm very confident for the place of real estate as an investment type going forward, short and long term. But I think there's once this whole growth is absorbed, what happens after that, I'm a little bit less comfortable. Again, not from the real estate point of view, from a global macroeconomic point of view of cybersecurity, things that can happen that would affect real estate.
Great. Silvia, thank you. And Will, would you sort of finish up for us?
Yeah,
could you include, wait. Could you include also any comments on the growth of e-commerce and how has that been affected by COVID?
Sure. I think everyone is aware that in 2019, e-commerce grew significantly as people were staying home and locked down. They were basically buying online, and as a result, the percentage of retail sales that was driven by e-commerce was very significant. And I think now some of that is going to continue, maybe not quite as much as economies open up, but there's still going to be continued demand for e-commerce, and therefore I think industrial warehouse logistics properties are going to continue to be attractive. And to basically respond to the optimistic or pessimistic question, I too continue to be optimistic, particularly in the short run, as all this stimulus and being pumped into the economy and things are opening up. I share some of Silvia's concerns longer term, as we have to then address the debt and the likely increase in taxes that could very well by 2023 or 24 slow down the economy significantly and maybe even push us into another recession. But I think for now, things look really good, really attractive. I think it's time to, and I think investors are right in terms of focusing on upping their allocations to real estate if they haven't already, because I think it can help meet the investor demands for their mixed asset portfolios in terms of offering return, income, and diversification. And in some cases, as Silvia pointed out, particularly with multifamily, maybe an inflation hedge. So there's a lot to offer here, and I do remain optimistic, particularly in the short to medium term.
Okay, great. Well, I'd like to thank you all for taking part in this panel and for answering the questions adroitly as you do. We're actually going to finish on time, which is great. And thank you for those who sort of sent in questions. We'll try and answer any more that do come in. And thank our experts, Martin Bruhl, past president of RICS, Silvia Gross, managing director of HQ, Martin, of course, is with Union Investment Real Estate, and Will McIntosh, global head of research of USA Real Estate. Thank you for this. Normally we do it in person in New York at the same time as the AFAR meeting, but today we've done it online. I hope everyone has found it interesting, because we tried to come up with good questions that you would like to have answered as out in the market. And I really appreciate all three panelists taking the time they've had to prepare for this and for being part of it today. Thank you so much.
Thank you.
Thank you. Our pleasure.
It was fun. Thank you. Goodbye, everybody. Stay safe.